Let's be honest, you probably clicked on this video because you keep breaching futures prop firm accounts, whether it's funded or evaluation, and you think it's your strategy, but it's not. You could have a genuine edge and still blow every single account because the account is set up in a way where it's not testing whether you can make profit, but whether you could survive. And almost everything you've been taught about your win rate, risk to reward is failing that test. So let me show you the math behind it along with my order flow balance method that you can implement to your prop trading. So if we begin by looking at a normal 50k account, right? This is pretty much an industry standard. This is what you are going to experience across most prop firms, right? This is the flex account. And the rules are going to remain the same or similar across multiple prop firms, multiple different prop firms, right? But this is what you have. So this is your 50k flex evaluation, specifically from Lucid, right? Lucid prop firm. You can see here that the profit target is 3,000. The max loss limit is 2,000, and a drawdown is a trailing drawdown, which ends at the end of the day, right? You have a consistency rule of 50%, but for now, that is irrelevant. This is irrelevant. Everything else is irrelevant. The main thing I want you guys to focus on is going to be the profit target and the max loss limit, specifically the max loss limit, right? Because this is the thing that really changes the game for trading, right? This isn't your usual trading. You have a max loss limit, and this is the constraint with these evaluation and with these funded accounts. As a result, the way you trade these and the way you risk on these accounts is going to be different to how you would trade, let's say, a normal personal account or, you know, a non-prop firm account, right? This is the thing. This is the killer. So you have a max loss limit of $2,000. In this instance, as we're looking at the evaluation, we also have a profit target of 3,000. So the truth is, your account isn't really a 50k account. It is a $2,000 account, and you have to make 150% to pass the challenge, to pass the profit target, right? So that is going to be pretty difficult to do. I'll be honest with you, that will be difficult to do. However, the leverage you get is from the pricing. You spend $100 for basically a $2,000 account, and of course, this locks in at your initial balance. But moving on now to pretty much the best way to trade this, right? The best risk management you can have. You are looking, when you're trading these, you are going to be focusing on the risk of ruin. You want to limit your downside as much as possible. You want to limit the risk of ruin. The risk of ruin is the statistical probability that you are going to blow that account. So by reducing the risk of ruin, you are basically protecting your downside. If we have a look at an example over here, let's say you are risking $400 per trade. With a $2,000 drawdown, you're going to have to lose 5 times in a row to hit that max drawdown limit. So how often do those 5 losses in a row happen? That becomes your risk of ruin. And if you look at this chart over here, this is the probability of seeing at least X consecutive losing trades within a sample of 50 trades. So this is your win rate, and this is the number of consecutive losing trades. So let's say over here, you have a 50% win rate. The chances of you incurring a losing streak of 2 is going to be 100%. However, the chances of this decreases as you increase the consecutive losing trades. And when you go from 6 consecutive losing trades to 7 consecutive losing trades, you could see there is a massive gap, right? There's a massive jump here from losing 6 trades in a row to losing 7 trades in a row. So based on this information, if you have a 50% win rate, it is almost certain that you are going to experience a losing streak of 6 trades. And if you're risking $400 per trade, you are going to blow that account. Because remember, if you're risking $400, you only need 5 losing trades in a row to blow that account to hit the max drawdown limit. And if you look over here, right, the probabilities of a higher consecutive losing trade frequency is going to just increase with a reduction in your win rate. So if you have a 25% win rate, let's say you make 1 to 5R on average, in the long run, you are profitable, right? If you're trading a personal account, in the long run, you will be very profitable. However, because of the constraint on the prop firm accounts and the maximum drawdown, which by the way, trails with your balance until it locks into your initial balance, making it even more difficult, you are very likely going to blow a lot of accounts if you have a 25% win rate. Because when you look at this diagram over here, losing 8 trades in a row, losing 9 trades, losing 10 trades in a row is almost 100%. Losing 10 trades in a row on a 25% win rate, it has a 90.7% chance within a sample of 50 trades, right? And let's say you increase your win rate by 10%, 35%, you can see that even though you increase your win rate by 10%, which is a massive jump, you still have high probability of losing a large amount of trades that is enough to blow your account. So generally speaking, what is going to be the best win rate for passing prop firms and getting that payout? It's going to be higher win rate strategies. Because when you look at these win rate, let's say 70%, you have a 100%, you have a near 100% chance of losing 2 trades in a row, fine. But 3 trades in a row, there's already a massive jump of nearly 30%. And then there's an even bigger jump when you go from losing 3 trades in a row to the probability of losing 4 trades in a row. It becomes 30%. So with a 70% win rate, and if you're risking $400 per trade, there is a 30% chance that you see a losing streak of 4 consecutive trades within a sample of 50 trades. And still, this is not enough to blow your account if you're risking $400 per trade, because you need 5 losing trades in a row to blow the account. Right, so that brings me on to the next thing. Why do you want to reduce your risk of ruin? The longer your accounts stay alive, the higher return on investment you obtain, right? It's exponential growth, because by keeping those accounts alive, you're not spending more on reset fees or evaluation fees, and you're able to farm more payouts from that singular account or from that same batch of accounts. And this is generally speaking. So if you're able to hold that account for a long period of time, the chances of you making more payouts within that account is going to be much more likely. As a result, the return on investment is going to be much higher, and hence that is where you get your exponential growth. So the key thing here is don't focus on the profit. Focus on keeping the accounts alive, especially if you are new, especially if you're not taking any consistent payouts, and especially if you're blowing every single account. The reason why I say if you're not taking consistent payouts is because there's different ways to go about it, right? Like prop firms, at the end of the day, it's just a money in, money out type of business model. So if you have less spend than your total payouts, then you're going to be profitable no matter what. However, you really want to capitalize on the return on investment where you can, right? Everyone would prefer a higher return on investment. But of course, there are different strategies that would work better if you're already taking consistent payouts, right? You have a higher bankroll where the return on investment wouldn't matter so much, because the actual dollar figure you bring in terms of profits is going to be high. If you're looking at it from an absolute value, if you're spending, for example, $100,000 on prop firm evaluations across the year, and you make back $300,000, the return on investment isn't going to be as high as someone spending $1,000 and making back $10,000 in profit. However, you still come out with $200,000 worth of profit. So when you're looking at it from an absolute figure, it doesn't really matter so much. There are multiple different ways you can go about it. But generally speaking, the longer your accounts stay alive, the higher return on investment you will obtain, right? You will experience exponential growth as you're able to farm more payouts, and your downside is already reduced because you don't need to buy any more evaluation accounts and you don't need to reset as frequently. And that is why you want to reduce your risk of ruin for the majority of you. So now moving on to some maths here, we have 2 traders. Trader A, the average risk to reward is 1 to 3, average win rate is 35%, and the loss probability is of course 1 minus 0.35. The losing rate is 65%. Whereas with Trader B, the average risk to reward is 1 to 1, average win rate is 70%, loss probability is 0.3 or 30%. Generally speaking, the lower the risk to reward you have, the higher the win rate you are going to incur. Because with a lower risk to reward, you can capitalize on just reactions. You don't have to be right on the day's expansion. You don't have to be right on the overall narrative. If you get a reaction right, the low risk to reward take profit, you will be able to capitalize on levels where you just get a bounce, where you just get a small reaction, right? That is enough to hit your take profit, and then price could reverse completely to your stop loss. But you don't have to be right all the time in terms of direction, in terms of expansion, or in terms of the overall narrative. With Trader A, the average risk to reward being 1 to 3, you're more than likely going to have a lower win rate because the chances of your take profit hitting is going to be significantly less than a low risk to reward strategy. Since common sense, the take profit is going to be much larger. Right, but if you look at these 2 traders, right, Trader A, Trader B, their expected value is 0.4. So for every $1 risk they take, they are going to make a profit of, on average, 40 cents. It's the same expected value. In the long run, both of these traders are profitable. Both of these traders are going to see similar results in the long run if they are trading a singular account. However, you can't account for the long run when you're trading prop firms because of that constraint you have, because of the max loss limit, right? Because of the trailing drawdown. You can't account for the long run when you're looking at the expected value. So even though Trader A and Trader B has the same expected value, when you're risking on $400 worth of risk per trade, Trader A is going to blow the account 48 times more often on average. How did I get this figure? Because on $400 worth of risk, the maximum loss limit is 200, right? It's 2,000. So 2,000 divided by 400 is 5. And when you do the loss probability of this, so 0.65 to the power of 5, you're going to end up with 11.6%, right? Whereas the loss probability of trader B, when you do 0.3 to the power of 5, you are going to get 0.24%. And when you divide this figure by this figure, is going to give you 48. So despite these two having the same expected value, i.e. they will make similar results in the long run, trader A is going to blow the account 48 times more often than trader B, based on this risk, based on the statistics of this maximum drawdown. And this is an example of why having a higher win rate is generally going to be much better for prop firms, because your risk of ruin is going to be reduced. However, that isn't the only way you could reduce your risk of ruin. There's another way. You could just risk less, because instead of risking $400 and having a lean way of 5 losing streaks, you could just risk $200 and require 10 losing trades in a row before you blow that account. But the problem with this is you don't really want to play prop firms too safe. You want to find a middle ground between conservative and aggressive. Even though you're protecting your account and you're increasing your safety buffer, it's pretty meaningless if you don't make any payouts, right? You can keep the account alive for as long as possible, but if you don't make any payouts, then it's pretty much pointless, right? There's no point. So with this, it does work in reducing your risk of ruin, but I wouldn't risk so little. I would risk just the right amount depending on your strategy, depending on your data, to pass prop firms fairly quickly and get payouts fairly quickly, whilst also reducing that risk of ruin at the same time. You don't want to give up too much of one side to enhance the opposing side. And of course, the second way is aim for a lower risk to reward, with the reasons I mentioned previously, because generally 1-to-1 instead of 1-to-3 gets hit more often, because you don't have to be right on an entire day. So it gives you a higher win rate, right? Higher win rate equals lower variance, and that is going to be much better for your prop firm accounts. So now that you understand the maths behind prop firms and how you could trade these accounts effectively, you are going to want an edge that will support that advantage. And that brings me on to my order flow balance method. So listen very carefully, because this order flow balance method is going to change the way you view the markets completely. It's going to change the way you actually trade the markets, because it provides you with a very specific framework of how the market moves. The market, number one aim is to facilitate as many transactions as possible. And the way it facilitates as many transactions as possible is through supply and demand. And as a result of supply and demand, this creates the 2 stages of delivery, or the 2 types of ranges. But before we get into that, I want you to understand the footprint chart. I trade with Orderflow. This is the footprint chart. It shows you aggressive participant on both sides of the market. There are 2 types of players. Aggressive players, those with market executions, market takers, and passive players, those who supply to the market, those with limit orders. With a footprint chart, you are viewing aggressive players. So on the right side is how many aggressive players hit the ask. On the left side is how many aggressive players hit the bid. 13 selling contracts hit the bid, 51 buying contracts hit the ask. Ask are your sell limits, bids are your buy limits. In order for a transaction to be successfully facilitated, an aggressive player has to be paired up with a passive player. So if you have a market buy, in order for that transaction to be facilitated, someone on the opposing end in the form of a sell limit has to be paired up with your market buy execution. And that is what you get here. So with the footprint chart, specifically, this is the delta cluster. It shows you how many aggressive players are in control, how many aggressive players either hit the ask or hit the bid. If you look over here, 101 aggressive sellers hit the bid, 161 aggressive buyers hit the ask. There is 60 more buying contracts than selling contracts. So the delta is positive, and this level is highlighted in green to represent that. So now this brings me on to the most crucial part of the order flow balance method. This is the pillar. It is going to be identifying your balanced state of delivery. A balanced state of delivery is where the market is building the most volume, is where the market is most optimal, right? That's where it's able to facilitate as many transactions as possible as both buyers and sellers are satisfied. And the best way to do this is to identify a range low and identify a range high. How do you identify a range low and a range high? When you have passive protection. What do I mean by passive protection? Here, you have large aggressive selling, right? Large negative delta, but the candle does not close lower and price action does not reward it with lower price action. This means aggressive sellers, despite being in control in comparison to aggressive buyers, there was enough supply at lower levels in the form of buy limits to absorb all of these aggressive sellers. So the market has no reason to move lower if the demand does not overwhelm supply. And that is a very important concept to remember. If the demand does not overwhelm the supply, the market is not going to move higher or lower to facilitate any outstanding demand, because there isn't any outstanding demand. So that is where you get your absorption. And this, because all of these aggressive sellers get absorbed by passive buyers. They are your buy limits. So this level becomes a level where you would anticipate for passive buying protection. And this becomes your range low. It's the same thing for the range high, right? When you look at these highs over here, you have large aggressive buying, large aggressive buying, large aggressive buying. They're clearly in control, but they do not get rewarded with higher price action. Passive sellers are absorbing all of these aggressive buyers, and this becomes a passive protection level for passive sellers. And when price comes back into it, you would anticipate for passive sellers to step back in again to protect the level, and aggressive sellers stepping in to initiate lower. As you can see here, this is initiation when you have large aggressive participant in control and they get rewarded with lower price action. Large aggressive sellers, and the candle closes extremely negative. So that becomes your range high, and this becomes your range low. As you can see, when we come back into the range high, aggressive buyers are in control, but they do not get rewarded with higher price action. Passive sellers are still absorbing all of these aggressive buyers, and they still want to protect this level. Hence why it becomes your range high. And what would you expect here? You would expect for price to stall and initiation lower. And once again, we come into the range low, aggressive sellers, no reward lower. Aggressive buyers step in and they try to initiate higher. However, in this scenario, in this case, aggressive sellers were still more dominant in selling demand, and aggressive buyers were unable to follow through with this initiation higher. And as a result, aggressive sellers take back control and bring price lower, breaking out of the range low. Now you're transitioning from a balanced state of delivery, from a balanced range into an imbalanced range. So this right here becomes your imbalanced state of delivery. Those are the only two stages of delivery, because the market always starts with a balanced state of delivery until one side of the market, whether it's buyers or sellers, they no longer become satisfied with facilitating transactions at this balanced range, and they want to break out of the range. As a result, they load up their demand and they break out. In this scenario, this was a successful breakout, because once we started to break below the range low, aggressive buyers try to step in. However, they do not get rewarded with higher price action, and instead they continue to get absorbed in an attempt to bring price back inside the range. Since it is an optimal state of delivery, the market always tries to come back into fair value. So this is an extremely strong confluence for buying exhaustion and buying absorption, and as a result, this is where you could capitalize on the expansion move lower. So based on what you know now, what do you think is going to be the absolute highest probability trades that you could take once you've identified the balanced range? It's not going to be anything within the range. No, it is going to be when we break out of the range and the opposing side of the market tries to step back in, bring you back inside our balanced range, our fair value, but they fail to do so and they end up getting absorbed themselves. So you get a break, retest. You're looking here in this specific example for any selling absorption where aggressive sellers try to step back in to bring you back inside the fair value, but they do not get rewarded with lower price action. So you want to see selling absorption to show you that passive buyers are protecting this level, and then initiation higher with aggressive buyers stepping in. That is going to be the highest probability trades, and this is where you are going to look for the entry. Once you've had that absorption, once you have that initiation, after you've had the break and retest, this is where you can look to go long to capitalize on the expansion phase higher. And this is the perfect example. Like always, you want to identify the range low where you have large aggressive selling, but they do not get rewarded with lower price action. So here, these aggressive sellers, large negative delta, but price action does not reward them. They do not reward the effort with lower price action. Passive buyers are protecting this level. If we come back, you would anticipate for the same passive buyers to step back in again to protect this level. And here, you have your range high, because it's the same thing, but just on the opposing side. Large aggressive buyers, but they do not get rewarded with higher price action. Large aggressive buyer, large positive delta, but the market does not reward it with higher price action. So these aggressive buyers are absorbed by passive sellers. When price comes back, you would anticipate for passive sellers to step back in again. So it becomes a protection level for range high, range low. Anything in between is going to be your balanced range. It is going to be where the market offers fair value. So you don't want to play anything in the middle here. You want to wait for price to break out of the range, show clear initiation, show clear one-sided direction and one-sided control, either from buyers or sellers, to capitalize on that imbalanced state of delivery. That is going to be very important. If you play price out, you can see we break below here, and this is where you should realize why waiting for a retest and waiting for the opposing side to step back in is going to be extremely important, because we break below. However, if you look here, aggressive sellers, they fail to hold demand. They fail to hold demand lower. They fail to fully break out of this level. And as a result, aggressive buyers are very easily able to step back in to bring price back inside our range. So if you just shorted after we had this break, you're going to take that loss. It's not going to be high probability, because anytime we break out of the range low or the range high, you would anticipate for the opposing side to step back in anyway. And the high probability setup comes once you've identified how we react after the opposing side steps back in. Whether in this scenario, aggressive sellers are still able to hold control and absorb any opposition and continue lower, or they fail to hold control, and as a result, this is what happens. Aggressive buyers take back control, even though we've broken out of the range low, and now we're coming back inside the range. So this isn't a trade here, because we didn't have any control from sellers afterwards. So now if you continue to play price out, we're just playing within this range still. The market within the range is going to be very two-sided. There's no clear one direction here, hence why it isn't the highest probability trades to take, until eventually we break out of our range high. But remember, you don't want to make the same mistake as when we broke out of the range low. So you always want to wait for the opposing side to step back in, clear presence of them, either in the form of retracement or large aggressive sellers, and identify where they do not get rewarded. That will be your confirmation, right? As you can see here, we have clear aggressive sellers stepping back in, clear control from aggressive sellers, bring you back into the range high. This is your break, this is your retest. Now this becomes a crucial level, whether we can hold this range high, which is an inversion level, or not. And the way we've identified this is the same way you identify your range lows. These aggressive sellers here, you no longer want to see get rewarded with lower price action, because that would mean they successfully took control and they successfully brought price back inside our balanced range. So this is where you really want buyers to step back in and absorb all of these aggressive sellers. And this is a first sign of an absorption, because you have large aggressive selling, but the candle doesn't close any lower. And instead, the next candle closes with a higher bullish body, with aggressive buyers holding control at the majority of its level. However, aggressive sellers still take back control. So now this just becomes a miniature battle of orders. Aggressive sellers in control, aggressive buyers in control. Now aggressive sellers are back in control. We are still looking for longs as long as we don't break below this range high. This range high is going to act as our last line of defense. So as long as we don't break below and buyers are still able to step back in again, this is where longs are still valid. As you can see here, you're getting clear absorption here, right? Nothing in the market is ever random. You're getting clear levels where you would anticipate for passive buyers to step back in. And this is exactly where. The reason why previously this is a level for passive selling, but now it's turned into a level for passive buyers, is because we broke above that level. So this aggressive demand basically converted these passive sellers and created new passive buyers. So now this becomes a level of inversion, where this was previously a level of protection. Hence why you would anticipate for passive buyers to step back in. And that is exactly what it is doing. Large aggressive sellers, but they still do not get rewarded with lower price action. Now, the next candle can very well still close lower, and then that would invalidate our trade. Right, that's still a possibility. Absorption alone isn't enough for a reversal. You always want to see initiation step back in, because absorption is just created from supply. But what actually moves the market is demand. It goes back to what I said earlier. So if you continue to play price out, we're still getting a lack of control, a lack of one-sided direction, where you have aggressive buyers clearly in control or aggressive sellers clearly in control. This candle is indecisive candle. So now you want to wait for the secondary candle. And as you can see here, buyers are starting to step back in, and these aggressive sellers are no longer getting rewarded with lower price action. So we've had indecision here with a battle of orders, and we're starting to get signs of buying control. And now it becomes more obvious. Large aggressive buyers holding control at the majority of these levels, but they are still getting somewhat absorbed by passive sellers at this high. So now the only line of defense for sellers is going to be these passive sellers at these levels over here. Once these passive selling level breaks out, then that is where you could anticipate for a pump higher, because right now you're getting clear signs of aggressive buyers in control. Aggressive sellers are nowhere to be seen. They can't compete with aggressive buyers. So the last line of defense is going to be your passive selling. And look at what you have here. Large aggressive buyers still holding control. These aggressive sellers no longer get rewarded with lower price action. Here, at this level especially, they all get absorbed. So this is where you can anticipate for the passive selling level to go, because aggressive demand is clearly overwhelming and any passive selling demand at these levels. This is where you could look for a take profit. Stop loss below there. And then you could target a rounded number. The next rounded number is 2800. And there you have it. That is going to be the highest probability trade you can take. Hopefully you guys found this video helpful. If you did, make sure you like and subscribe. And if you want to learn more, then check the description where I do offer one-to-one mentoring. This covers everything from A to Z, my framework, my OBM model, how to pass prop firms, how to get funded, how to make consistent payouts with prop firms. It covers everything trading related, and you have access to me for lifetime. Apart from that, take care, and I will see you guys in the next one.